Welcome to today's RaaS Research Group Stock Take webinar, where we will dive deep into the analysis of another promising ASX-listed stock. As you know, we scour the ASX looking for cracking companies to not only introduce you to, but show you the research and give you the insights that RaaS has uncovered in their due diligence. Today, we're focusing our attention on Cash Converters International, ASX code CCV, an Australian-based consumer lender and second-hand goods retailer with owner-operated corporate stores and franchise-operated stores across Australia and increasingly overseas. RaaS Research Group's detailed analysis, presented by Senior Analyst Graeme Carson, will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making an investment decision. So pay attention to Graeme's presentation. He's dived deep into cash converters and done the work on your behalf. This presentation will then be followed by Cash Converters International CEO and Managing Director Sam Budiselik providing a detailed presentation, plus he will participate in live Q&A where you will have the opportunity to submit your questions directly to management. Please feel free to submit your questions using the Q&A function on your screen throughout the webinar at any time. I will collate them, and put them directly to our presenters during the Q&A segment. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst Graeme Carson, who recently released detailed research on cash converters with the key insights to be shared with you today. Graeme, over to you.
Thank you, David. Thank you for hosting, and thanks to the attendees for their interest. So Cash Converters is a name that most people will know. It's been around in Australia for a number of years and in the listed space, but we think in many ways it's very much a misunderstood company. So I would like to take you through my research today to let you know how we've gone about it in terms of due diligence and what the outcomes of that research process is. So if we can just move through the disclaimer, please, and then on to the agenda. So the way I'll approach this, I'll talk about the business generally, a bit of an overview, and whether we think Cash Converters does make sense, both as an operating business and potentially as an investment. We think it's now well positioned after a few periods in its history where it's had some challenges. They've been worked through very well by management to the point where they've got to today. We'll then look at the financial position and our resulting forecasts and how we actually value the business overall. Then we'll check that valuation as a bit of a common sense check against like-listed peer group before we talk about the key sensitivities and some of the potential catalysts that we hope to look for in the coming months. So next slide over in the overview. Does CCV make sense to us? I'll just cast attention to the box at the top right there. You can see the code, the price, and the market capitalisation of 141 million. So it's a reasonably substantial business. It's been around for a long time. But we think that when people think of cash converters, rightly or wrongly, there seems to be a bit of a stigma attached to it still. The business was growing. The heart of the business and its origins were in the store network. And there is still a significant store network, both domestically and offshore. And within that store network, some of the stores are owned by the company and some are franchised. They've got a strong presence in Australia and growing in Europe, most notably the UK. So in Australia, there are, I think the current numbers are around 153 cash converters all up. Just over half of those, around 79, are owned by this corporate entity we're looking at. And in the UK, they've recently made a significant acquisition where they now own 47 stores of the total 190 over there, which the remainder of which are still franchised. Within that store, outside that store network, which is regarded sort of basically as a retail business to an extent, there is actually also a material personal finance lending business. And this is driven mostly out of the Australian market, but there is some in New Zealand and to a lesser extent the UK. But it is significant that the loan book at the moment on a group-wide level is sitting around 275 million. Last year to June, the company did 383 million of revenue and just over 20 million of net profit after tax. Again, back to the stigma. I mean, it's worth remembering that Cash Converters operates in what is without doubt a heavily regulated environment. It's a compliant business. The regulators both here and offshore do understand that non-bank lending is an important part of the economy, but it does need to be regulated. It looks at the moment like the client base is certainly showing a lot of interest in this sector, and we know that the bank lending has over time become more and more difficult, and their priorities have shifted. So there's a significant part of society that does need this. So we think that the regulatory framework, although it's tight, will have to continue to be conducive so that it works for both sides, the actual consumer and obviously the companies themselves. So we look at the third set of bullet points down there. Excuse me. We think it is well positioned and actually catalyst rich. So the business is now fully funded, which I'll go into detail shortly, with the recent upsize of the finance facility. The store networks, both domestically and in the UK, are performing exceptionally well, evidenced by the FY24 result and again in the first quarter of 25. And we think that loan book on the personal finance business is set to grow, and the product mix changes in there, which is actually an important part of the valuation and how we approach it, which I'll go into in more detail. And then beyond that, that's all organic growth. Beyond that, the company has stated that they will continue to acquire franchise businesses and bring them within the corporate network, again, domestically and offshore, most likely. And they have proven that they know how to integrate these. They already know the business as well. And the way they bought their UK acquisition recently and what they've managed to get out of that under their ownership has been very impressive. So that's the overview. If we go to the next slide and we look at where the business is positioned now, we'll look at the chart on the right in a moment, but it's probably worth looking at the recent history. Now, over the years, Cash Converters has operated in an environment that has had its challenges, as we've spoken about, both legislatively and regulatory. And the most recent material change was a domestic market where the regulator changed a lot of the parameters around the small loan products. And they were historically a prominent part of Cash Converters' product offering, but they are now exiting what was previously known, I guess, for want of a better term, as payday lending, into a different product mix. They also had regulatory challenges. They had an enforceable undertaking from ASIC going back a couple of years. Now, to go through that process, it was very rigorous, everything from products to processes to credit models. The company addressed all of those, and I think it was January this year where they got a tick of approval, which means the complete product offering is now regarded by the regulators as absolutely compliant in what is a very tough framework. And I don't think you can say that for some of the other participants in the non-bank lending space due to they haven't probably gone through such a rigorous process, but I think that leaves Cash Converters well positioned. What we are seeing in the business is this change in business mix. As I've said, the small loan products, otherwise known as SACC products, are being transitioned out of the business. And then in conjunction with a strategic decision the company made to remove the GLA business out of the loan book, which is the auto finance business, that capital that is being released from those two products is being redirected to medium loans, MAC, and a new line of credit product, which is showing fantastic metrics early on. What this has resulted in is very much improved net loss rates in the loan book. Again, improved significantly in the first quarter of 25 just gone, and I'm sure Sam, the CEO, will talk to that in more detail. Outside the lending business, the store network is performing well around changes in product mix and other various strategies for the retail business, both domestically and offshore. And in terms of offshore, the UK business is now delivering a very much increased contribution. So if you want to cast your eye across to the chart on the right there, that's actually the EBITDA, 2 years historical, 3 years forward in the business before corporate overheads. But just to look at it as a product mix, you can see the darkest bar at the bottom there. That's the store operations in Australia, in New Zealand, and in the UK. Oh, no, just Australia, in Australia, actually. Then the biggest chunk there you can see is the personal finance business. So it delivers around half, if not more than half, of the operating EBITDA of the company. So it actually is key. And that really doesn't have a great deal to do with the store network from a direct earnings perspective. So you can think of it as a lending business. At the very top there, the lightest bar you can see is the UK. And you can see the increased contribution over time. That was acquired, which you see that contribution in 24. And we expect it to grow well, and they acquired that well and have delivered fantastic synergies and growth out of it. So now that the management has basically got the business strategically very sorted out in terms of what they want to deliver over time and how they allocate capital to it. They've got all the regulatory ticks in place. So now growth is on the agenda. And the clear ones there are the ongoing loan book domestically, and again, that is being directed towards a lot of new products, and the store acquisition program that we've spoken about. So management has said that they will acquire more stores in Australia and most likely the UK and even potentially other parts of Europe as well. So the next slide takes us to our the financial position of the business and our forecasts around that. So again, the story here is organic and acquisitive growth. We aren't particularly aggressive in our acquisition assumptions in our model because they're obviously very difficult to quantify, both from a timing and scale perspective. So our forecasts are largely organic with a little bit of growth from acquisition in there, which I can talk to in detail if anyone's interested. But this results in forecast compound revenue growth of 8% from an FY24 base out to FY27. There's a bit more falls through at the EBITDA line on some operating leverage and other bits and pieces, which delivers a compound growth of 13%. Again, we think that there's upside potential from here if the acquisition profile becomes more aggressive. Basically, what the company is looking to do now is it's freeing up capital from releasing those old products into new products, plus it's increased its senior finance facility a few months ago from 150 million to 200 million. So that change in loan book and now more capital for growth really puts the company in good position to direct capital to the highest return on capital products. And we see cash converters as fully funded completely for these forecasts here, which again, we don't think are particularly aggressive because they have growth optionality for other areas. So you can see at the NPAT line, we believe it's growing pretty strongly from the FY24 base out to FY27. And if you look at the PER of the business or the EV to EBITDA multiples, you can see that there's some pretty significant value when you're only paying 6.4 times PE current year or 3.7 times on an EBITDA multiple. Again, we'll talk about the relevance and the value in that in a couple of slides' time. So onto our valuation. We use DCF valuation because we believe that the growth profile of the business is strong and it will accrue over the coming years. So we discount that future cash generated earnings back to current day amounts. That DCF valuation of 42 cents. Again, we're not using particularly aggressive parameters there. The growth rate terminally of only 2.2%, probably a little bit below inflation. The beta of 1.5 when the observed beta is actually just under half that. So, we think that there's a fair bit of value given it's trading at 22.5 cents. Some other metrics just for common sense check. As we've said, EBITDA 3.7, PE ratio 6.4 times current year, 1 year forward that is, and improving pretty markedly across the balance of the forecast period. And the yield is something that a lot of retail investors and potentially some institutions will like. It's a fully franked yield, currently at 8.9% per annum, and that improves again over time. I think the metric is that cash converters may have paid a half-yearly dividend for something like 8 interim periods in a row. So I would suggest that the dividend is not at risk and it's comfortably funded within the bottom line earnings of the business. So now we check on the peer comparison table how cash converters sits versus its peers. Now this peer group is basically non-bank lenders, all listed in the Australian space. You'll know a lot of those names, varying sizes. A lot of them are bigger than cash converters. In fact, the average market cap amongst that peer group is just over 700 million. The forward PE is a mixed blend as well, but it averages out at the 25 number at 11.4 times. So you can see, given that we think cash converters has got a strong growth profile and is currently priced at 6.4 times or a 44% discount to that peer group with a basically 9% fully franked yield, it certainly stacks up from a value perspective as we see it. And again, the likelihood is that the company may even be more aggressive in its execution of its growth strategy than we're allowing in our forecasts. So what can we expect in the key sensitivities and catalysts in the next page? Again, the upside, when we talk about upside case and downside case, we're saying upside case versus our existing forecasts. And again, what are the risks versus our existing forecasts? So as we've said, upside case is more acquisitions than we're allowing for. But the loan book growth is higher than what we're assuming, and the order mix changes. And then the accelerated improvement in risk metrics, which is the bad debts, which are improving materially as the business mix changes. The downside case, of course, is material economic weakness, which impacts potentially risk metrics, and you might see increased losses in the loan book, or material rises in interest rates, which will impact funding costs, and there's always timing issues there. And as we've said, it's a highly regulated industry, so you can never say never that there won't be further changes, but we think that both the geographic and business diversity within Cash Converters mitigates those risks to an extent. Potential catalysts to look for. The company has said that they have an active pipeline of acquisitions, both domestically and offshore. So if they come to fruition, we'll get more of a look through into the size and potential earnings benefit from those acquisitions. So that could provide a catalyst. And we would hope that would come through in the next 6 to 9 months. Again, proof of traction in new loan products. I've put in there the line of credit product, which is the newest one with fantastic risk metrics that was trialled last year and is now being rolled out across the network more aggressively. And then we talked about the PE discount that Cash Converters is currently trading at. So we think if they can prove this ongoing earnings with growth, that there is a potential for a re-rate back towards sort of the industry pricing more generally. So that is it for me. Obviously, I'll be back for any specific questions that people have. We've been covering Cash Converters for a year or so. So we've released a number of reports over that time. The company has delivered to everything that it stated when we started covering the business. So if anyone wants more information, there's a bit of a portfolio of research in there for your reference. So thanks, David. Back to you.
Thanks, Graeme, for that detailed analysis. And as I said at the beginning, I think really sets the scene for Sam's presentation. You've now got the analyst view, and remember, a recently released detailed report has been released on the company by Graeme and RaaS Research Group and can be found on the RaaS Research Group website. We'll get you back in a minute, Graeme, and ask a few questions. And if anyone has questions, feel free to submit them using the Q&A button. Now it's time to hear directly from Cash Converters International CEO and Managing Director Sam Budiselik, proving that Cash Converters is a bricks and mortar business. Got the ideal backdrop and ready to present is Sam. So Sam, over to you. Thanks for your time.
Thanks, David. Thank you for having me, and thank you, Graeme, for that overview. If we could just turn to the next slide, please. We start really taking the back step on our business and trying to explain, the modern business. I think, the business has been well known over 40 years of operation for the retail and pawnbroking service that we provide. More recently, the business has really transitioned to become a significant non-bank lender, offering personal loans into our customer segment. And that is a significant part of our business now, operated through our stores and online, contributing over 2/3 of our EBITDA. So we're a big non-bank lender, still with a very important store network for us, enabling us to reach our customers and help serve our customers. We do offer a significant circular economy service, which has become a modern day focus, I guess, of consumers as we're looking to reuse and repurpose items. And, we're the biggest trader in that space. And we do receive a significant volume of applications through our stores and our online platform to assist people in not only Australia, but globally. And we'll talk a little bit about that. If we could please turn to the next slide. We originally, with the circular economy or the second-hand trade focus and pawnbroking as an offer through stores, had an opportunity to expand our service offering into our customer segment. We offer a particular customer segment support. It's a very large part of the economy in Australia and the UK, where we're really focused and growing in terms of that need for credit and finance. We are really well loved by our customers in terms of our NPS scores, and our brand is well known and regarded and trusted. And I think that high street presence is really important to continue to, build on that trust and to be there for our customers in a large corporate way where, they can trust, they feel there's a real business backing the service offering, and they can drop in and get some support, help and advice from our store guys. As Graeme touched on, we've got a pretty significant revenue line at a bit over $380 million a year. We do generate strong earnings. We have been paying a 2 cent per annum fully franked dividend for over 4 years now, as we reinstated that. And, we've got cash on the balance sheet that allows us the ability to think about steadily growing our business. And we'll talk a little bit about where we're focused as we move through the presentation. If we could please turn to the next slide. I think Cashi's really, the genesis of the business was created on the back of a franchising network. And, that was really initially focused in Australia. And that franchise model then went global. And that's something that's not often understood, that we have a big global network of Cash Converters stores supported by a great network of franchise partners. And, I think our franchise model, initiated 40 years ago, was probably one of the original franchise models that emanated from Australia, certainly. The stores are profitable. They're well governed. We provide the platform, the IT, the brand and marketing support to the network. But really, we're focused on Australia, New Zealand and the United Kingdom in terms of our corporate operation. We operate as the master franchisor. So not only do we operate our own company-owned stores in those markets, but we're the master partner for the franchisees in those markets and directly focused on ensuring they're well capitalised to grow their loan books and positioned to service a large customer pool. And then beyond that, we have partners who license our brand and our trademark and platforms in some instances to offer the model into other jurisdictions. And I guess that's important because those networks have also been in operation for many years and are profitable. So we do have good growth and growth optionality beyond our core Oz UK markets. But in the medium term, we're very focused on buying the franchise stores back in those markets, as David touched on in his introduction. We'll talk a little bit more about that opportunity as we move through the presentation. If we could please turn to the next slide. We in Australia offer an unsecured finance product. It's a big part of our business, as I mentioned at the start. I think it's a very important part of not only our business, but a service to Australian borrowers that is really, required and conducted in a responsible and regulated way, meeting a need sensibly. And our finance business is fully regulated by ASIC and AUSTRAC. We sit under the National Credit Act for our loan products. So we have to meet all of the sensible protections and checks and balances that the banks would in terms of issuing credit. But we're very particular about the segment of borrowers that we're focused on supporting. And really they're borrowers who, in finance terms would be described as non-conforming. They're borrowers who traditionally have had an issue with credit, or they have irregular income, or they might have some marks on their bank statement and that would cause a bank to turn away. And as we know, that's more common now than it ever has been with the bank's view on risk profiles. Having the biggest customer data set and repository enables us to build the best credit models to allow us to build a good picture of our customer segment and to determine the borrowers that will perform well. And if you look in the bottom left of this chart, you can see our average credit scores are really to the left of the more traditional finance providers. That is, our customers have lower credit scores. However, that's not the only determinant of the way someone's going to perform or whether a loan would be responsible for that person. So we need to build well beyond the traditional credit bureaus and the information provided that the banks may rely on, using our own credit models and informing our own insights. But it's a huge part of the Australian market. Non-bank lending in general has become more, widespread. And I think when you look at our peer group, we've got the advantage of really owning what you would call the subprime part of the credit market. that's traditionally borrowers below, 350 or 400 traditional credit score. So we're really the biggest operator in that part of the market, and that really is our core customer segment. But over time, we've been evolving our business to move towards competing more in the near prime space. And a big part of our transition away from what has traditionally been referred to as a payday loan or a small loan, it has been a part of using our technology and the advancements that we've made in our credit models, enabling us to then offer lower cost, longer term loan options that opens up a new part of the customer base that we've seen recently. That's more that near prime customer that's sitting to the right of the traditional, credit profile that we have seen in the business. We do have a fairly young cohort of customers too. So, they're people looking for support that, are trying to meet a need in life. It could be a car repair, it could be, a white good purchase, or it could be the need for some money to travel, or, those sort of reasons for loan. If we could please turn to the next slide. On the retail side, the business has also changed quite significantly. We've really seen a focus on retail trade increasing, particularly over the last sort of 2 or 3 years. The store inventory mix has changed quite significantly now to incorporate luxury handbags, watches, electronics, and high-end jewelry. We have an online platform operating that offers all of our store inventory for purchase and dispatch. So you can wander into a store and have a look at the item, or you can buy online. The items come back with a warranty. We have valuation certificates. We have authentication technology running to ensure that the goods are genuine, and we can stand by that. And that's quite a unique sales proposition in the secondhand market if you compare ourselves to a Facebook Marketplace or a Gumtree or one of those other secondhand, direct retail sites. And as a result of the changing inventory mix, we're seeing the ability for our store model to move into different demographic areas. So we are moving inner city in Paran, on Toorak, on Chapel Street, in Melbourne. We have just opened a luxury store in Bondi Junction in Sydney, and a smaller footprint, lower wage cost, higher value inventory is allowing us to move into some new areas that we haven't traditionally traded in. We do still offer the full service concept out, in the suburban areas, but this is certainly a trend we're seeing growing, and it then influences the collateral provided on the pawn book market as well. And higher value inventory is generating an increase in pawn loans too, which is great. So it's quite a significant change. If we could please move to the next slide. What we were hoping to show here was a video of the Paran store, and I'll hopefully this will play okay. We can make it available if not, but I'll ask the guys to kick the video off if it's going to work. So it's quite a different concept when you walk into the store. The smaller footprint, you see the inventory, the trainers, the sneakers, the bags, the watches. It's quite a noticeable difference in inventory mix, very high end. We've always traditionally sold jewelry and watches, but we're seeing higher value jewelry and watch inventory coming through the network, generating a different segment of customer coming into the stores. Thank you. If we could just turn to the next slide, please. So really, the traditional business model is now predicated on a first-class technology platform, and we're cloud-based. We process a large volume of data on our lending and retail business. We've built a proprietary platform in-house. We take for our lending applications 90 days of banking as a starting point to build a profile on a borrower. So you could imagine we have a lot of bank statement data. We've got integration into all of the modern day payment platforms to enable us to disperse cash instantly. And I think the technology, even across the retail side, as mentioned, assisting with authentication and web and app deployment, has really seen the business reaching new, younger customers, and positions us well, not only trading through a COVID type event, but just in general reaching a new subset of people that are looking for value, or they're looking for an alternative to a new item purchase. If we could please move to the next slide. So just to bring our strategy together, I think if we can go to the next slide, please. What we're really focused on is, optimizing and growing our Australian business. There is still quite a bit of upside as we release new loan products to, move further up the credit spectrum and to deal with more people that are looking for a non-bank lending option. And we do still have plenty of greenfield expansion opportunity in Australia and in the UK to open new stores. We're not anywhere near saturated in terms of sites. We think that with the approximately 150 Australian stores, that number could grow to 200. We'd see similar growth opportunities in the UK. And I think as we're coming in as a corporate operator and able to fund that expansion, that's something we'll see continuing to happen. But really, we see a low risk opportunity to continue acquiring back the franchise stores in Australia and the UK that we don't already own. And it's really a function of our franchisees having been in the system for a long time and some looking for a natural exit. We're paying multiples that aren't, unreasonable in our mind, and we've got the balance sheet to fund those acquisitions. We have a very good view of those businesses from a top line perspective, and we can model how we think those businesses will perform once they're owned by a corporate operation, and we've got some data just to support that in a minute. But in summary, acquiring those franchise stores back, growing our core loan books, continuing to innovate with our customers and reaching new customers are three really exciting growth strategies that we've got underway. If you could please turn to the next slide. Just as touched on, to demonstrate the power, I think, of the franchise store acquisition strategy, as was touched upon in the introduction, we recently purchased a 42 store network in the United Kingdom that was owned by our biggest franchise operator, and thereafter have made another 5 store acquisitions in the UK. The UK is now contributing, about 20% of our revenue, over 10% of our profit, and it's growing revenue at a 17% rate in FY24. It's a big, growing, strong market for us. And with that acquisition, key was a management team that's been in our network for a long time that enables us to continue acquiring those stores in the right way. In Australia as well, there's a big opportunity to continue folding the franchise stores into our corporate network. And, we've got a pipeline where we're having discussions ongoing with franchisees who may be keen to exit. We already have the infrastructure and the operations and management teams in place. When we buy the stores, traditionally the people transfer across, and it's fairly easy for us to consolidate them into our current corporate network. And we have started acquiring those stores and validating that our modelling, is spot on. If we could turn to the next slide, please. And the next one. So really, what does this mean? I kind of step back and look at our business. It's probably, I think underrated for the number of customers we deal with and for the size and complexity of operation that we manage. We have a big revenue base that, it is changing in terms of margin as we move away from that shorter term loan product. We're positioning the business over time to get bigger, build scale, generate earnings streams from multiple product sources and geographies. And that's a very key change the business has really undergone. With a big growing loan book that's well funded, it puts us in a strong position to continue, returns to shareholders under a fully franked dividend payment, 1 cent per half, as mentioned, and also to continue steadily growing. And our Q1 result, considering the change of composition of the loan book and the direction of the business, was really pleasing. That revenue is still ticking up. Importantly, our loss rates are moving down. Our credit models are working well, and we're really well positioned to continue executing our strategy. If we could turn to the next slide, please. Just to drill into a little bit more detail, as mentioned, I think our revenue growth has been significant considering the change in mix of revenue. We foresaw a deliberate product shift away from small payday loans because of the political stigma and the perception in the market of that product. Whilst our products are very well structured and it provides good consumer protection, we've challenged ourselves to continue innovating. And I think, bringing that loan book down and winding the volume of the business back a bit. It has the benefit of bringing the loss rates down, as we're seeing, but we've offset some of the revenue decline with store acquisitions, and particularly offshore in the UK, giving us a more diversified revenue stream. And our loan books continue growing, and the new loan products are performing strongly, which is really exciting to see. If we could turn to the next slide, please. The gross loan book, as mentioned, we've continued that loan book growth. Probably a key call out is that we conducted a review of our vehicle lending business, Greenlight Auto. It was a business through broker distribution platform. That loan book grew north of $70 million. But when we looked at the return on capital in that loan book, lined up against the opportunities that we have in front of us, there was a compelling need to make a change to release the cash equity that the business had in that loan book and to redeploy that capital to, we think, more aligned to our core strategy and focus, acquisition opportunities that we've touched on. So the loan book top line growth won't be such a focus for us. We're still seeing good underlying demand and growth in our core loan products, but now we're repositioning that book into medium loans and a line of credit product. It's a very different, look and feel for the business that's growing strongly. And that transition of the vehicle loan book down continues. And over time, that cash will free up to allow us to continue to execute strategically. If we just turn to the last slide, please. I think the key point there is that all of this is being done with a net loss rate that's improving. So we're taking a little bit of volume out of the business. The quality of customer and the performance of the customer is improving. As a result, with a margin reduction in the lower cost loan offer to our customers, lowering loss rates mean that we can manage our profitability and our financials, as we are seeing through our results as we reposition our business. And I thought if we could just go to the last slide, please, just to close out, David. I hope we're okay for time. It's really just underlying what we've been talking about. Our strategy for growth is focusing on acquiring those stores in Australia and the UK that we don't already own, that are operated by a franchise network, and continuing to optimize and innovate our lending products. And that gives us an opportunity to consider about our Aussie and our UK markets offering, similar products across those geographies, leveraging our insights to ensure that we're managing the business well as demand is growing in our customer segment, and continuing to focus on generating good earnings growth and, supporting that dividend yield. And with that, thank you, David. I'll pass back to yourself.
Thanks, Sam. Thanks for that insightful presentation and comprehensive overview of the Cash Converters international business. As you say, it's come a long way and is vastly different to what I think the bulk of Australians and Australian investors may think the business is. We're now going to move to the live Q&A session. So if anyone does have questions, submit them using the Q&A function on your screen, and I'll be put those directly to Graeme and Sam as they come through. Some pretty good questions coming through. One here for you, Sam. Been with the business 8.5 years by the looks. You sort of came in at a pretty tough time. What was the goal, and how focused did you have to be? And how hard was it, I suppose, to bring everyone along the journey of where you thought you'd get to?
Yeah, interesting question, David. I often reflect on this as I'm asked by my friends and family about the mission that we're on and the purpose of the mission, I guess. And there is a wider driver for that, I think. Coming in and understanding our customer segment more and meeting customers in our stores and our people, I really fell in love with the challenge, I guess, of trying to do what we do better. And, we're a big volume business dealing with a lot of people that need help, and doing that in a responsible way is something that we really took seriously. And, 8 or 9 years ago, there was a commitment to doing that in the right way. And I think, under the hood of the business, whilst we've got good, strong financials and top line growth, there's been a really big shift of the business as we're making that happen. So I think, in summary, if you think about us receiving maybe 60,000 applications a month for finance help, and, really approving about 20% of that flow, there's a lot of people still out there that I feel that we could help, as demand keeps growing, and leveraging technology and, the financial side of the business, restructuring the securitization facility, rebuilding the underwriting platform, leveraging that technology has been a huge challenge and something that, you know, I've really enjoyed. And then the second part of that was rebuilding our social license, I guess, engaging with the regulators, engaging with the advocates, engaging with Canberra, you know, to really make sure everybody was aware of the need and the importance for a big, you know, well-governed and regulated and responsible operator operating in our market.
I touched on somewhat in jest at the beginning about the fact that you still retain your bricks and mortar history and operations, but clearly a substantial fintech business now in its own right. How did you pivot? How did you find that moment when you went, hang on, we're seeing all this data, we're going to have to rebuild our platforms, and we think that's going to yield results in the future? A pretty risky bet, but what was the underlying driver? What was the aha moment when you saw it and went, right, I can see what we have to do here. It's going to be tough and we're going to have to invest, but I see where things are going.
Yeah, and doing all of that with a franchise network was an extra degree of spice and challenge. Yeah, look, I think we have the benefit of, you know, a substantial offshore shareholder operating in the US, and our UK business provides insights. And, you know, 10 years ago, I could kind of see the trajectory of consumer finance changing, and that need to be online was, you know, without debate. But I think uniquely for us, as banks have really, you know, pulled their branch networks back and moved out of that direct face-to-face service to bring their cost-to-income ratios down, we had the view that we could complement our store network with our technology and our online platform. It was never going to replace our store network because that network itself really provides an important service to this part of the economy that is sensitive to assistance, you know, responsible lending and direct face-to-face engagement. So, you know, whilst we get a lot of applications online for our finance, half of our approved loan flow is still through our store network. I think on the retail side, obviously the advent of the Facebook marketplaces and Gumtrees meant that, you know, at one stage I remember being asked early on, did we think we're at risk of being knocked out by the bigger global platforms? And again, we felt that standing behind the products that we were selling was really important, offering a safe environment to do that. I mean, it's not for everyone to sell something on one of those sites and have people turning up at their house and then having issues post-sale with a you know, an electrical fault or something like that. So again, we've managed to sort of take our unique service proposition and our direct customer engagement and then offer multi-channel engagement. So, you know, some of our store customers would transact online, some would still choose to deal in store, but the online platform certainly opens us out now to a wider section of customer.
We'll jump into the stack of questions coming through, so we will just jump straight into them. What do you think of your return on equity ratio metric? Where should it be when the business is performing really well?
Yeah, look, I guess like I get frustrated that for the size, scale, and complexity and customer feedback, our business isn't regarded as something much bigger. And I do present at many small cap events where I look at some small cap businesses and I think, wow, we're a lot bigger than a lot of the small cap peers in our space, based on market cap. I think the way we look at our modeling around our returns, our internal rates of return on any deployment of capital versus what we're doing now, our unit economics on our product mix, really brought a lot of discipline into the business around that and making sure we've got the best data science guys, the best you know, financial planning and analysis guys that we can find. Recently appointed a new head of strategy and commercial to make sure that we're always looking at how we maximize the deployment of capital and the returns we're achieving on that capital. So I'm confident that the business is really well positioned to keep growing into a growing customer segment in the right way. We've got the smarts in place to control how we're doing that with our loss rates coming down, the quality of our loan books improving. Our store formats are shrinking, so we're lowering lease and wage costs, increasing gross margins in the stores, and we have a growing market on top of all of that. So I think as we see earnings grow, I would hope that, the market returns on our stock improve, but also our returns on equity and our balance sheet flex. The scale in the business is huge. We can continue growing that top line revenue and open those jaws, as they say in banking terms, but hold our cost base flat and keep scaling up our revenue. And that's that next few years where we should really see earnings growing as a result. So that's what I'm most excited about.
And there's a couple of questions.
David, I might jump in there as well, if that's all right. Just from our perspective, when we look at return on equity in the business and where it takes us going forward, I think at the moment it's low double digit return on equity, and we've got it pushing up towards mid-teens at the end of the forecast period, and that's as a result of capital being directed to higher return assets, combined with no requirement for further equity in the business. And as it scales, you get the higher bottom line profitability off the same equity base. And this is the period when that starts to accelerate on our current forecast. So when you're pushing a business like this into return on equity of 15%, you're well above your cost of capital on any level, and that's where you get the incremental increase in inherent value, we think.
Just on that, Graeme, there's a question that's come through. You haven't been very aggressive with your acquisition assumptions in your forecasts. Can you shed some light on that? And based on what the company is doing and what it believes it can do, how do those assumptions change?
Well, before I talk about my assumptions, it's probably worth touching on what Sam had already spoken a little bit about in the presentation, which was those UK acquisitions. They were done in, I think from memory, March 23 and June 23. First low of 42. Cap cash was done in March and the second in June. The acquisition price was, for round numbers' sake, around 25 million Aussie at around 5 times EBITDA or thereabouts. In other words, they were generating about 5 million in operating earnings collectively at the EBITDA line. Now, just 12 months later, they did more like 10 million at the EBITDA line, thereabouts, or maybe even a little bit above. So if you go back, it's been bought at 2.5 times rather than 5 times if you look forward, which sort of shows you the returns that these guys can generate. If they can do that again, time will tell. But in our assumptions, we've only assumed $8 million of investment capital is directed towards acquisition in each of the 3 forecast years that have been released. And given that they've made that $25 million acquisition last year and they've now got a bit more firepower in terms of investable capital, we wouldn't be surprised if the number averages out to a lot more than 8 million on average over a 3-year basis.
Just on that, Sam, I won't ask you to respond to assumptions or forecasts. That's Graeme's job. But in terms of the growth potential of the UK business, how do you see that rolling out? And are there wider opportunities in Europe more generally?
Yeah, I think, obviously we own the 47 of the, there's another 140 something franchise stores in the UK, and that network's, really well established and performing strongly. Beyond that, we are still growing in the UK with some of our franchise partners opening new sites. For example, Wales hasn't got a store, and we'll put some corporate stores into play in Wales. So I think the underlying market growth there is exciting, and we've seen that with our, the UK business growing its revenue circa 17% in FY24. It's a big growing market, and I think that gives us a very strong beachhead in Europe to sit there and have a look at the other operations that are operating. We've got operations in, Belgium, in France, in Spain, that are big businesses that are performing really well. So there is that growth optionality over time to consider, either helping fund and grow those businesses or to take an investment position in those businesses. But, that'd be a more a medium-term objective, I think. We're very bullish on that UK market continuing to grow. And there's no unsecured lending in the UK. It's just a pawn market. Culturally, the UK, it's very accepting of pawn, and consumers like pawn as a finance option. So we don't feel the need yet to offer an unsecured product in the UK. But again, there's some product growth opportunities in the UK too. So, very excited about the UK and the opportunity that it presents as a result.
And the franchise store acquisitions, are they an opportunity in Australia and UK? Do you think there's more opportunity there?
Yeah, I really do, David, because we're almost a victim of trading at such low multiples. We've had to compress the valuation offers to the franchisees as a result. I guess one benefit is we can say, look, we can only offer you so much for your stores. When you line up against, a buyback or another opportunity, we'd have to deploy capital, which we do. You're talking sort of 3-4 times EBITDA. As Graeme mentioned, the UK was a bit more, it was 4.8 because of the size and scale of that operation and that beachhead footing into the UK. Also the management team. I can't talk enough about how important, the people are, to have the right people in place. And, we've really worked hard on building the right team over there. So, yeah, I think both of those networks, for similar reasons, are just compelling, and we'll continue to execute sensibly where we can, reach that agreement on price. Not always with franchisees, but we've really got a good pipeline that we're feeding. We're being tight on the pricing, and I'm confident we'll continue acquiring and growing as a result.
You mentioned in passing a buyback. Is that something that is on the cards or potentially on the cards as a deployment of capital initiative?
Yeah, I think the board, as you'd expect, considers all options for optimizing returns to shareholders. And we've got a fully franked 2 cent per annum dividend being paid on a 22-cent share price. It's not a bad yield. Everything's considered in terms of that capital structure as well, and our balance sheet. I'd probably mention, of the circa 60 mil of cash that we've got on the balance sheet, some is tied up in working capital, inventory and stores, in our securitization facility. It's not all available cash, so it's not like there's a big pot of cash sitting there that we could just go and bosh a buyback with. So we balance. We want to keep growing the business so that over time earnings keep growing, and it just gives us better optionality for returns going forward. And that's really the short-term focus, I think.
You touched on a fantastic yield, and a yield that's been consistent over a long period of time. An obvious question here from shareholders, given cash flow increasing, NPAT continuing to increase, is there an opportunity that yield may get better through further or increased dividend payments over time?
Yeah, I'd love to think we had that option going forward. Myself and the management team are certainly aligned to that. I guess one point to note also is that our lending, our interest rates are capped by legislation. We haven't passed any of the increases through to customers that we've seen in terms of funding cost increases. So as we've floated up with borrowing costs increasing, we've absorbed that too. So, I can kind of see over the next few years, as we continue executing our growth strategy and, assuming there's a slight decrease in funding costs, the whole business really starts growing earnings, in a substantial way. And then that gives us, optionality for all sorts of outcomes, really, I think.
And how are management incentivized? What does the structure look like?
Yeah, we're fairly traditional, as disclosed through our annual report. We've got short-term incentives and long-term incentives, short-term cash incentives, longer-term equity incentives. I certainly think about equity investment in the business as being important for our team because of the shareholder value that we're creating. And, that long-term incentive plan with a number of, I've really built a new team here over the 8 years when I've brought the people in that I needed, that I trusted and rated. And we're seeing some of those equity tranches vest now. I think it's terrific. So we'll certainly have skin in the game. We're very committed to that share price focus and growth. And it's something that really drives us, that longer term view.
Final question. The transition from payday lending, do you have any thoughts on how you made that possible for your customers and what that means for the business moving forward?
Yeah, look, it's a really interesting topic because the company, we essentially got debanked, as many other non-bank lenders did 10 years ago. And I think for us to raise our funds to lend to our customers, we have to go offshore. Hopefully that's something that changes too over time. I think it should. But that challenge of offering, it's a regulated loan product that people didn't like because it was largely misunderstood, I think. I mean, annualizing a short-term rate and talking about it was quite misleading. But look, that's the reality. And I think what we started doing is saying, how do we overcome the problem of high loss rates and high risk that would enable us to offer a lower rate product, to some of our customers? Some customers, due to their risk profile, would never qualify, unfortunately. But many we could transition as we used our technology just to improve our credit models and really trying to nail the right customers, in terms of their profiles to offer them a lower rate. And it really moved the industry away from everybody offering cap pricing to, some lower rate offers for customers. So that was a really important challenge where I think size of data, size of flow, insights into our segment with machine learning technology deployed, which really became available to us probably 6 years ago, completely changed our credit risk models and our credit profiles. And then we built a data science team to keep innovating that.
We have exhausted all questions, and I think you've handled them beautifully, both Graeme and Sam. So thank you both for presenting today. I'd also like to thank each of you for your participation in the webinar, engaging in the Q&A. We hope you found this webinar informative and valuable, and we look forward to seeing you at our future events, where we will once again dive deep into the analysis of another promising ASX-listed stock. Keep an eye on Cash Converters. It's more than a bricks and mortar business. Fantastic dividend yield, strong cash flow, strong NPAT growth, and strong plans for the future. Sam, thanks for your time.
Thank you, David. Thanks, Graeme.
And Graeme, thanks for your insights also.
Thanks, David, and thanks, Sam.
I remind everyone, head to the RaaS Research Group website and download the research on Cash Converters and do your own research before having a look at the stock. An interesting stock to watch and one we will follow with interest. Thanks, everyone, for your time. Have a great day.